Hello traders, Gary Wagner here. Approximately noon on Friday in Honolulu, the 4th day of November. And this is the daily report for gold and silver, our weekend review. As this week comes to a close, the one thing that can characterize this week overall is extreme range once again and extreme volatility in the market. We had gold closing higher on the week, silver closing lower on the week. In terms of daily gains or losses, we did see the precious metals soften today. 1754, down about $10 in the cash market in gold. Silver off about 35 cents to close at 34.14, 34.09 ask bid spread. Both candlesticks, in terms of the weekly candlesticks, can be characterized by the extreme range that the market hit, first of all, and the fact that they formed what is simply called a rickshaw man, which is a form of a long-legged doji. Again, the doji is simply a candlestick in which the open and close are either identical or very, very close. And you can see that in this week's activity. This, of course, is a continuous contract of our COMEX gold, which means that it's currently taking off the December price of COMEX gold. As you can see here, take a look at the kind of range that we saw in the marketplace. On the low end, this market actually dipped below 1688, 1680 being that one critical area that we have talked about before. But the interesting thing is that buyers absolutely came into the market when this market hit that low. And in fact, you can see the open here and the close because it's green above it. You can also see the high just touching right around that 1776 area. That's a 23% retracement, 38% retracement, 1680. And you can see that during this week, we have pretty much accounted for this entire range, top to the bottom of this trading range. It was a volatile week indeed for gold. As far as silver goes, again, a volatile week. Let's go ahead and take a look first at our weekly chart. And you can absolutely see in terms of the low down around $32 per ounce. The high is sitting at about $35 per ounce, so a $3 trading range within a week. That's a considerable trading range when you take a look at this single candlestick here. Now, the body size is much larger. It's certainly not a doji. It would almost be hammer-like, but the body size, again, is much too large. But in terms of the range, I will go ahead and pull up our daily chart so we get a better idea of what we're looking at in terms of support and resistance levels. And traders, we are looking at a daily chart. This is the cash silver market right here. And as you can see, 3509, that is there's a bid-ask spread, the lower of the two. And a couple of things kind of pop right out at us. It's quite apparent. First of all, superlative resistance above 3501, and that is the 61% retracement. But it's also a Fibonacci harmonics because 3505 is a 50% retracement. And when we look at what these retracements are from, we're looking at two different ranges. So the first Fibonacci retracement, the shorter of the two, is 44 down to 26, call it 2587. The second of these two starts at the second of our record high, up around $49, down to this record low here, 2587. Again, call it 26. So the difference between this high right in here, 49, and this low, if we take a look at, for example, a straight 61% retracement, that's going to be this area right here, a 50% retracement right in here. They come out to be about the same. And as you can see, there can be no question, but we had some real resistance here because when the market did try to take that out, it was able to close at that point. On the following day it opens, closes above, but you can see trades below it was unable to hold that ground. Steve Nissan would call this basically a scouting party. In a scouting party, what happens is as this market is pushed up, the bulls attempt to check or look at the fortitude, the strength of the sellers. And as they come into the market, you have multiple sellers coming in, pushing this market back down. Now, where were they able to push it to? Well, when we take a look at the different levels, you can see there is some real strong support at 3023. And 3023, of course, when we take a look at it, is a 76% retracement of the entire move from $44 down to $26, going down 76%. The 76% retracement of this longer move comes up over here, and you can see that the market did come close to, but could not take that out, and in fact we found very good support. The market recouped on the next couple of trading days. This would be Wednesday and Thursday, and of course Friday. Today we had a lower trading day, down about 35 cents on the day. So what can we say was the prerequisite of what we saw? Well, first of all, we did get a basic turnaround in both our equities markets and the dollar index. When we take a look, first of all, this is the dollar index. This is basis the December. And when we take a look at our daily chart, you can see that after being down for a couple of days, it was up slightly. But consider this week of trading, 1, 2, 3, 4, 5. When we convert this daily chart to a weekly chart, the real tail of this marketplace is a much stronger dollar throughout the week. Of course, here is the high right here. It closes well off the high, but in terms of a two-day pattern, you get this engulfing bullish. Of course, before you would take a signal, whether it's a weekly, a daily, or an intraday chart, you would need to get what is called a confirming candle. A confirming candle would be if next week this marketplace opens and creates a higher high and a higher low in terms of the trading week itself. Let's pretend that this is the candle here. And if we saw a candle such as this after this engulfing bullish, which is this week's candle, this would signal on a much longer term basis, on a technical basis, meaning using candlestick patterns to diagnose the market, this would signal higher dollar values overall on an interim term basis. Now, how did this affect our markets in terms of our equity markets? We did have a equity market under a little bit of pressure, not too significant, but here's what I am seeing. This, of course, is our daily chart. We had two strong up days. This followed a major sell-off, and this candlestick itself is a small-bodied, almost hangman-like, and the difference, again, between a hammer and a hangman is if the market has been moving up and you get this particular candle shape, this is part of the umbrella group of candles, you get this type of a candle, it is known as a hangman. If the market has been coming down and you get that same candlestick, what that signals is called a hammer. So it's the same candlestick shape, the same market scenario, but you determine whether it's a hammer or a hangman by where it appears in the current trend. So, most importantly, what are we looking at for gold and silver next week and in the short term, the interim future, let's say, through the first part of November? Well, there's a couple of scenarios. I personally think that we are going to be witnessing a rally, and that rally is going to take place as this marketplace trades higher. However, when we stay within our standard Elliott wave count, this is the shorter term of the count itself. And if you work with me, we are looking at wave 4. This is wave 5. We get our A, our B, and our C correction, which puts us into an impulse phase. The way my count is looking right now is 1, 2. This was 3. I would expect 3 to go anywhere between 72 and somewhere below this 1828, because I think this will be the top of it. I would expect a little bit higher, possibly one more retracement, and then a boost back up. And that's where I think we'll see this market take off in a big way to the upside. And I also believe it will break 1800 per ounce as it moves back into familiar territory. Now, what are we looking at in gold? Well, in silver. In silver, as you know, I am not as bullish. I have not been as bullish, but I do believe that it will follow in the footsteps of gold. If gold trades higher, I think you're going to see silver follow suit, but not in the same percentage. I think that gold will overtake silver in terms of percentage gains. But let's be honest, it's got to be able to take out this $35. If it can take out the $35, my belief is the next place we're going to see this market move is going to be $37.83. Call it just below $38. In terms of very good support, I see strong support right at around $33 per ounce. And I think that once we see this market break out of this particular narrow trading band that we have defined our trading in lately, and when I say trading band, I'm looking at 33 on the low, 35 on the high, this $2 to $3 band, I think that only then will we see higher prices, but it needs to, on a closing basis, be able to go and close above $35 per ounce. And then I will go ahead and revise my belief in what I see this market doing over the next month. This has been Gary Wagner wishing you, as always, good trading. And we'll talk to you on Monday for another daily update. We'll talk to you next week for our weekend review viewers. Have a great weekend. Bye-bye.